Welcome to my guest today, George Roberts with Horizon Multifamily. George, how are you doing today?
Fabulous. And thank you, Jonathan. I've been looking forward to this podcast.
Of course. Likewise, I'm happy to have you here. Why don't we start out with you telling us about your background, how you got started in real estate, and what your work in real estate looks like today?
Yeah, sure. So, long story, I was in bioscience, went into data science, really wanted to have a little bit more personal freedom, ended up loving the world of entrepreneurship through a construction project that I started with my sister and brother in law. And along the way, I had a single family rental unit that introduced me to the world of being a landlord and really just put the two together. Decided I love entrepreneurship, I want my own enterprise, and I know how to be a landlord, so let's just do it at scale. So I went into multifamily real estate. What things look like for me today, I spent a lot of time putting people together, so I have a lot of events. Spend a lot of time on the YouTube and on events like this because I do syndicate real estate. And I spend a lot of time looking at deals because I do mentor people. So if you have a deal, you want somebody to look at it, not sure if you're ready to proceed, happy to do that. I don't charge anything, and I'm happy to jump on the deal if you feel that I'm adding value.
George, you have a really wide background from bioscience to data science. Are you still working a W 2 job or is real estate full time for you?
No, as we record this at the end of February, I'm about 13 months out of my W 2, and it was pretty good timing. I had been building my off or my on ramp, either way you look at it, for quite some time. And I was very happy to just have the opportunity to go completely out on my own.
I want to talk a little bit about that because it's a common theme in the real estate world. Lots of investors have these lofty dreams of quitting a W 2 job, being a real estate investor full time, making tons of money, and life is great. Can you walk me through your process now, 13 months into it? What sort of things did you think about? What did you take action on to get ready to leave the W 2 world and go into real estate full time?
Well, first thing is to have some passive income. So I'm not only investing on my own as a syndicator, as an operator, but I also invested in some other people's deals as well. I tried various phases of real estate. I did a hard money loan, soft money loan. I wanted to see as many ways that I could get money coming in, see what really makes sense, works for me. And really, for me, I just wanted this day to come as soon as possible. I'm going to try and say this as politically correct as possible, but since 2020, people have been at each other's throats, and the office, well, it isn't what it used to be. So I was really happy to get out of that environment, and I was willing to work all evening, weekends too, to get there just as quickly as possible. But I don't recommend that people leave any earlier than they have to. So definitely, I would say make sure that you can keep that stable income coming in as long as you can. It'll really help to make sure that you do survive as an entrepreneur.
I think that is really, really valuable and sound advice. I experienced the same thing. I spent over a decade being a teacher and in the non for profit world before I left that and went into real estate full time. And I think there are a lot of voices out there that are encouraging you to, burn the boats and just go all into real estate. Sometimes some people not really encouraging you to put much thought into it or preparation, and so really like your advice of hanging on to your stable income for as long as possible and starting to create passive income streams. I know some people just kind of go into real estate without having much of a plan, without having any passive income built up first. And it's just really dangerous. It puts you in a tough spot. It can make you desperate for deals and can also kind of hold you back in terms of financing and funding deals because banks don't tend to like to lend to people that don't have any income. So I think really, really sound advice there. Your background
Yeah, huge
in
advantage signing on loans.
Yep, absolutely. Your background in bioscience and data science. Tell me how that background, which is seemingly very different than real estate, tell me how, if at all, that background played into the skills that you bring to real estate.
Well, first, in terms of motivation, I mean, for me, even to get into industry, that was a huge leap in terms of having personal freedom. And when I did get into industry, I went into data science. Those skills are exactly the skills that I use to vet a deal today. When I look at the economic environment, when I look at local conditions, when I look at markets, I'm using those same analytic skills.
Yeah, it makes a lot of sense. Vetting the deal and underwriting is such a key component of getting good deals. And something I know that some investors struggle with is making projections. It's one thing to see the numbers as they are, or even get a trailing 12 months and seeing what the history of a particular property has been, but making projections 1, 3, and 5 years down the road, I think is a real challenge, because in one sense you're trying to predict the future, but you're also trying to take all these different factors happening in the marketplace, both macroeconomically, but also locally, wherever that property is located. And you're attempting to make projections. And that sort of thing can be really challenging for investors without a solid underwriting background.
Absolutely. And you don't really have to go all out. I mean, you can start, if you invest in someone else's deal, take a look at those projections. Do you believe them? Where would you modify the projections? And then look, 6 months, 9 months, 12 months down the line, 2 years, 3 years, did things turn out as you expected? Why didn't they turn out? Did you have some conditionality in your projections? For example, if interest rates go up, well, hey, we might be in some trouble with this bridge loan, for example. Were you able to predict the situations that led to some of the difficulties you saw? And you don't really have to have necessarily a whole lot of money on the line to do that, but there's a bit of a skill to it. But again, also remember that nobody has a crystal ball, and you want to be as careful as you can with the numbers. But at the end of a day, the only two things we can do is make conditional predictions and then stress test, which is really just a fancy name for taking a look at those various scenarios and say, hey, what if the exit cap rate is a little higher than we expected? Do we still make our returns? What if we can't refinance at the end of year two? Are the investors going to be happy? The more scenarios you run, the safer you're going to be.
Can you talk more
And have a
about,
cash position. I would say that's the number one.
say that again, have a cash position?
Yes, keep a cash position. That having a war chest, having cash on the side, that's better than anything. It's even better than having a low loan to value. You want to make sure that you can maintain your mortgage payments, and that if, for example, construction is a big part of your game plan, make sure you padded that a little bit. Make sure that you're going to be able to get where you need to be, regardless of what life throws at you.
Do you have a rule of thumb that you're going by at this moment in terms of how much cash you want to have on hand?
Well, two things. So first of all, your deal has to have appropriate amount of cash on hand. So you're probably going to want to make sure your underwriting includes deposit to replacement reserves. You're going to want to make sure that your construction budget is padded, say at least 10%. You might want to take a look at your rent escalator. I wouldn't set it more than 2%, but your expense escalator. That might be at a higher rate because we might have inflation for quite some time. So, in other words, rent escalator. What I'm saying is, don't count on rents going up 3, 4, 5, 7, 10, 12% like they have in recent years in some markets. But do count on the cost of labor and the cost of supplies being potentially much more than what you have projected.
I want to go back to your comments on all of the different factors that go into underwriting and making projections. So modeling out all of the different scenarios. This is something that I really struggle with in my investing. I'll model out all these different scenarios of what could potentially happen in terms of interest rates and rents and vacancy. And my underwriting is a little different than yours because I'm more underwriting in the non-residential space. So it's a little different, but same idea. How do you marry all of these factors together? Because you really could model out a serious doom and gloom scenario. And you also could model out a really rosy scenario. And we all know the reality is probably going to be somewhere in between that. But if you're modeling out something so negative, you can model yourself out of every single deal. And if you're modeling out everything so rosy, you can get yourself into some really bad deals. So, can you talk a little more about how you
Right.
marry together all the potential things that can happen to what is realistically going to happen?
Right. Well, I think you need to know where you're being perhaps a little bit more on the optimistic or on the conservative side and make sure that that at least balances. So if you have some modeling that is maybe dependent on, say, interest rates staying where they are at currently, realize that may not be the case and make sure that you're making up for it someplace else. But actually, one thing I'd like to add to the prior answer, which I think applies here as well, is not only do you want to make sure you have proper working capital in your deals, make sure that all your budgets are padded, but you want to make sure you have at least one partner that does have some additional financial wherewithal. Make sure that you have some cash, some gold, some commodities, something that's likely to keep up with inflation. Because if you do get into the point where there has to be a capital call, you want to make sure that you don't want to have to go back to your investors. Much better to have the partners lend that to the deal at 10% than to have to send out an embarrassing email that's going to make your investors are going to freak out. It's not going to be a good situation.
George, you're heavily invested in the multifamily space. You're active in purchasing and rehabbing large multifamily properties. I've heard you talk on other podcasts about how multifamily syndication has become a very crowded space. And I'd love to get your insight into the last 3+ years or so. We saw some. We saw some crazy prices over the last few years. Now we're seeing some moderation. I'd love to get your insight into kind of the last 3 years of the multifamily world and where you see it at today.
Well, yeah, I mean, to take a quick tiptoe through the tulips, first of all, housing demand increased like crazy. You got people going to their second home because they're affluent and they're working from home. You got Airbnb eating to the housing stock. You've got builders that are frightened, literally scared to death because they saw what happened to their cohort 10 or 12 years ago. And our housing starts, our permits just crashed. And all of a sudden, wow, housing costs a whole lot more. Rents went up like nuts and people made a lot of money. I mean, if things were crowded before then, just as soon as people realized that the pandemic wasn't going to kill real estate, people jumped in like crazy. I think part of the problem, I hate to say, is the gurus. There are a lot of gurus out there that are churning students out like crazy. And each, we can't grow exponentially, whether it's syndication, single family home ownership as a landlord, et cetera, or pretty soon everybody in the economy is going to be in real estate. And one of the great things about a free market economy is that, yes, you do see the profits when there is a need, and you're going to get more people in. But now we're at a point where there's a danger that there are just too many people that got in the door. They're all looking for the same deals. And if you're looking for that 100 to 200 unit deal, Class C in a Class B neighborhood, and it's got a pencil. I mean, come on, there aren't that many deals like that. So I've made a real concerted effort to get into some other things. When I invest passively, I'm in a triple net deal, which is a drug rehab facility. I'm in a private equity deal that is a car wash roll up. And everything I'm doing, including my hotel to multifamily conversion, right now, it's designed to make sure that if things continue to get more crowded and if multifamily in general becomes a difficult place to make returns, that I can take my investors somewhere else. And even within multifamily, I want to take people to tertiary markets, places you haven't heard of, places where you might be the only person submitting an LOI or an offer on an apartment. And I found that some of these places, they're terribly mismanaged, and you have some serious rent increases just by bringing the place up to some basic modern standards.
Yeah, I think you touched on a lot of points that a lot of us have been thinking about in terms of the gurus and all of the mentorship programs in the multifamily space that have been so prevalent over the last few years. And um, I know a lot of those people are well intentioned and their aim is to teach and to help people. Um, but one criticism that I've heard about some of these people is that they're teaching people how to collect fees and not so much how to manage large multifamily properties. And do you have any thoughts about kind of where you see some of those operators headed? Are you starting to see any distress with some of those inexperienced operators, or do you still think it's too soon to start seeing distress from the inexperienced operators?
Well, it's the lender contacts where I hear that first from. Oh, yeah, I see these bridge loans coming due. Oh, yeah, I've got one that's distressed. This one might go to foreclosure. Yeah, there's a lot of troubles. We have a lot of people trying to get the last bit of meat off the bone. You might buy a property that's maybe 50% renovated, and the seller wants to sell it to you at a price as if it was 100% renovated. So people buying at the wrong price, people getting stuck in bridge loans, people who haven't been conservative enough with their financing, not getting fixed financing, and maybe they have floating, or maybe they have floating and a cap. Always better to have fixed. Better yet to have fixed and under market, something you can really only do if you get seller financing, and something that I work really hard to try to bring into my deals.
You spoke previously about diversification, and you often speak about the importance of diversifying. You touched on different markets, you touched on different asset classes, and I'd love to go a little deeper into this concept of diversification. Can you talk a little bit more about first um, your motivation behind diversification? Is it because multifamily you feel is overheated, or are you just waiting for some of those inexperienced operators to fail, for lack of a better word? Or do you just have those interests and you think it's safer to diversify outside of multifamily?
Well, I think maybe all of the above. I'm not saying that multifamily is necessarily overheated yet, but I am seeing that it is becoming harder and harder to project those returns and to execute and bring those returns home. So, without a doubt, I am looking at the margins to find some better things. But again, there's also the selfish aspect that I want to learn something from every deal I do. So, if I go into a deal as a limited partner, half of it is because I believe in the returns, but it's almost certainly because I also believe that I'm going to learn something from working with that operator.
So you hit on a couple things there that I think are really interesting. When you're a limited partner, how do you learn from the operator? I think it's a tendency for some to just sit back and maybe you read the email updates, but there is also an opportunity to learn from that operator, especially if it's an asset class that you're not familiar with. So, what do you do to learn from operators of a deal that you're a limited partner in?
Well, first of all, it starts with vetting the deal. When you are asking questions about the deal, or when you see people asking questions in a webinar, for example, how are they treated? You should probably have at least a 15, 30-minute talk with the operator. How do they seem? Do they seem personable? are they interested in teaching you what they have to learn? And I would say that I wouldn't discount reading those monthly reports, quarterly webinars, etc. Those are also wonderful as well. But the main thing I think is that if you see somebody who's not communicative before they get your check, then it's only getting worse afterwards. You might want to ask, do you have references? And how often do you communicate? Make sure that communication style works for you. But I have to say, I have not been in a deal yet where I haven't learned something significant from the operator, some sort of hurdle that had to be cleared, or some clever way of getting around an issue.
Do you do anything while the deal is ongoing? Are you having regular communication with the operators, or only if something goes wrong, or are you just sort of learning from those email updates?
Well, usually it's a variety of things. I tend to be pretty passive. I don't like to ask a whole lot of questions. I'm pretty busy on my own end, but again, I do choose people who I believe will be there to answer the phone to pick up if I need to.
On the diversification topic, you touched on something that piqued my interest. You talked about a triple net deal. I think you said it was a drug rehab center.
Yes.
I'm really interested and involved in the triple net world, so I'd love to go a little deeper on that deal. What's your involvement in that deal, and can you tell me a little bit more about it?
Sure, I'm strictly a limited partner, and it's cool to have these deals these days because, I mean, you know what's coming in. And if your tenant has to pay all the expenses, if expenses tend to go up quite a bit, you could do very, very well. You also have rent escalators, etc., that can help to keep up with inflation. One thing I'd like to say about triple net, and I wish I was the expert here, Jonathan, but when people say triple net deal, they make, oh, yeah, well, that means that your tenant's paying for everything, right? Your taxes, insurance, upkeep of their area, though not usually their common area. But that's not my definition of a triple net. My definition of triple net, who pays? Go read the lease. Every lease is different. And I just interviewed somebody very recently who had a CPI clause in the lease. So now their rents will keep up at least with the CPI. There's a big difference between that lease and a lease that doesn't have that sort of clause over the last year or two, and who knows, maybe over the coming year, two, or three.
Well, that's some great negotiating on the landlord's part. I have not seen a lot of those CPI adjustments, but I mean that really, if you can get a 5+ year lease with CPI adjustments, that's a pretty sweet deal for the landlord. What market is that in?
So this is Clinton, North Carolina. So my understanding is you want to have something that's close to a population center, but the land has to be maybe a little cheap. You want it to be uh, maybe off the beaten path a little bit. May not be good to do this in, say, downtown New York City. No offense, but I mean, if you're tempted, temptations abound in a big city. So the idea behind this one, and I think it was very unique, they brought in an operator who really understands the literature and who designed a program that's expected to have greater than 70% success. And that's really unheard of. And what's being done here is just bringing together all of the very best practices in the industry.
You
But
hit on.
again, your tenant is going to,
Go ahead. Go ahead.
oh, sorry, go ahead, please.
Oh
Your
no,
tenant's going to have a lot to do with.
I was just going to say that you hit on two really important factors of the triple net world. First, you talked about the importance of knowing that lease, or at least working with someone that really knows the lease. The lease, you mentioned the CPI escalators, there are going to be all kinds of different things buried in that lease. When a deal is brokered and you see the offering memorandum, the broker, the listing broker, might advertise it as triple net or absolute net or double net or whatever, and it's really just semantics. It's just vocabulary. You have to dive into that deep, or dive into that lease deep, or have an attorney do it or have someone on your team do it, because there are going to be all kinds of different factors, like like parking lot, like the roof, like HVAC. All of those, little different aspects can change a deal massively. And there could be different factors in there, like tenant is responsible for HVAC repairs up to a certain amount, maybe up to $2,500. But if it has to be replaced, it's the landlord's responsibility, which could be a $50,000 or $100,000 bill. And so it's just because something says triple net or absolute net does not necessarily mean you're comparing apples to apples. Really, really important to dive into all the details of that lease. And then the other really important factor you hit on was vetting the operator. So in that deal that you were talking about, you talked about the experience of the operator and that you feel really good about it. So a lease is really only as good as the person signing the lease. And so, somebody could make all kinds of promises and sign on a lease, but if they have zero net worth and zero assets and they go under, you as the landlord, there's really not a whole lot you can do about it. So yeah, thanks for hitting on those two really important factors of the triple
Actually,
net
Jonathan,
deal.
can I add one there
Please.
about reading contracts? So you'll never understand a contract as well as the day you read it and sign it. And that's the day that I like to prepare an abstract. So I have, like, for example, a property management contract, and there's so many things here. Like, we have to have liability insurance and, add as additional insured. We have to tell them who's going to be the address for correspondence, $350 repairs or less. We don't even get asked. 60-day divorce period, all these things. If I didn't write that down, I'd be digging and scrambling. If I said, hey, I don't like this. How do we get out of this contract? Oh, yeah, it's 60 days plus 1 month rent. And then I had a conversation with a insurance broker, and he said, hey, do you realize that your current insurance policy doesn't cover pipe burst, snow and ice, assault and battery, as well as ordinance and law? So you got all these exclusions. And think about it. I mean, this is a property that's sort of in the middle latitudes of the country. We could have a pipe burst. There could be snow and ice. We had snow in Texas this year.
Absolutely. I think those are really important factors, because once you read that lease, after that, you might read 20 more leases. And then if something happens and you have to go back to that lease, I mean, you're going to be rereading the whole thing, because you're going to be like, oh, the HVAC went out. Oh, the parking lot has to be repaired. Am I responsible for that? Is the tenant responsible for that? Have they been keeping it up like they were supposed to be? So I think that's a great idea, is to have a summary or abstract of that lease, so you can easily and quickly hit the big details. George, you are really active on LinkedIn and YouTube. You're doing a lot of education in the real estate world. One of the things that you like to educate on is the importance of the average investor being aware and updated on macroeconomic trends. Can you talk a little bit about why the average investor needs to be aware of macroeconomic trends?
Well, consider where we've been coming from. We've had a stable, longest recovery we've had, I believe, since World War II. And I think a lot of people have gotten lulled into this idea that, hey, all you got to do is buy a decent property at a decent price, put a property manager in there. I don't know. I'd say that playbook has been torn up and ripped to shreds. A lot of people who were able to follow that playbook and who may have done extraordinarily well in the past, I would say watch out. You've got to understand not only macroeconomics, but your local market. We know we have a huge housing crisis right now, and I follow the housing report every month. If you follow me on LinkedIn or you find my YouTube page, youtube.com/at George Roberts III. That's III. I'll be happy to tell you exactly what's going on in the recent housing reports. But remember, that's on the national level. You got to really dig in. You got to look at the absorption in your area. Make sure that you're not in a situation where you might see your rents go down or the per unit go down if you have a whole lot of new product dumped onto the market. People need to understand inflation and interest rates. You got to understand what sort of loan you're looking for. What does it float on? Is it based on the 10-year treasury, for example? Are you following that? What are your projections for interest rates or for inflation? And again, nobody has a crystal ball, but you have to have an educated opinion. And when I look at investing, I look at it holistically. Okay, so look, we're in real estate, and that is a hard asset. That's a huge advantage during inflationary times. But people need to think about other things as well. Should I be looking at commodities? Should I have a position in gold? What should my cash position be in a volatile market like this? And if you don't have an idea what's going on in macroeconomics, I really don't know how you're going to make intelligent allocations and then pounce on those deals when they do come. Where are you going to get the liquidity from?
Do you have any suggestions on where people can be updated on basic macroeconomic trends? I don't think it's realistic to expect people to have a master's degree in macroeconomics, but is there a source that you recommend or anything like that that can help people kind of stay up to date with the basic economics of what's happening in our world?
Well, I'm glad you asked, Jonathan. Why me, of course. But seriously, Fred's a great place to go. Fred.stlouisfed.org. You can find all sorts of charts. It's all free. And I could spend an entire productive day just looking up the things that I'm reading about in the financial press, checking them, putting one graph versus another, plotting, and doing combinations of various time series. So I would say if you are inclined, go learn how to use Fred. And I've actually got some videos about how to do it. And it really, I think, only takes, I would say, a couple of hours at most to become very, very proficient. And you can be a true consumer of the data, not just somebody who goes to the financial press and says, feed me, tell me what's going on. But you can actually get out there. You can be a producer of information and you can understand it in a way in which I believe even in many cases, the financial press doesn't seem to understand the numbers.
Yeah, great suggestion. A resource that I really enjoy listening to every day is the Marketplace podcast from NPR. It's only about 25 minutes long, and they really break down economic trends that are happening on a daily basis. So they do talk about Fed rates. They're also talking about housing. They talk about the non-residential world, what's happening with goods and services and retail and the industrial world. And so I think that's an easily digestible source that really does help me in my investing. George, with your education on macroeconomic trends, your YouTube channel, your presence on LinkedIn, I've heard you say that all this networking and the community that you're creating online has revolutionized your business. Can you talk a little bit more about the importance of your education and the community that you're building and how that's helped your business?
Yeah, absolutely. Well, you have to get out there and provide value if you want to have a network to depend on. So I have a lot of events. I go to LinkedIn, got my YouTube channel. My stuff goes out all over the place. If you want to get to the point where you have that network to draw on, you're going to have to probably leverage a VA. I have a great VA. She helps me to be in all places at once. But speaking about how it's revolutionized my business, now that I have gotten my name out there and people know they can come to me for education, I used to have to go and call up brokers to look for deals. I spent a lot of time in spreadsheets and doing underwriting, and I still do. But I would much rather re-underwrite a deal that's been brought to me where somebody says, hey, here's the narrative here. This is the angle on this deal. This is why this deal makes sense, rather than go through a whole bunch of numbers that probably lead to a deal that doesn't pencil and which the broker's take on the deal is, well, we know 95% of the time there's a lot of pie in the sky there. So getting out there and providing the value, there was a lot of work on the front end, but it has led to a much more rewarding real estate career where I get to take calls from fascinating people all over the country, introducing me to deals and markets that I would have never heard of.
Did networking and building community and this education aspect come naturally to you, or was it something that you really had to work on?
Well, for me, it would be naturally. I came from academia, so I had been teaching myself. I guess I do have a little bit of an academic spirit still after having spent so many years in academia, PhD, a couple of postdocs, etc. And I think that when you do come to real estate, because we need a lot of people to come to real estate. I mean, I talk about it being crowded, but we still need more people to come in, build units, rehab units, operate units. You're not coming from nowhere. You're coming from someplace. You have some talents and you have to figure out what they are. So I enjoy teaching people. I was a Toastmaster. I really enjoy getting out and speaking in front of audiences. And I love analyzing data. So for me, I had to figure out, well, how am I going to differentiate myself? Well, I decided I am the data scientist of real estate, or maybe Dr. Housing. And you just have to play up what you got. So look into your background, figure out what makes you special, different than most other investors. What do you have to offer that makes you unique? Why should people come to you? And you have to play upon that strength.
I want to talk to you about social media in particular. You're active on LinkedIn and YouTube. I want to talk to you about what's working. Have you cracked the algorithms of those websites? You can talk about them individually, but in terms of LinkedIn, are there certain types of posts that you see gets more views, more engagement? Are you putting your YouTube videos on LinkedIn? I've heard that sometimes LinkedIn can kind of shove
Throttle.
videos down because you're linking elsewhere. So can you talk about kind of the nitty gritty of what kind of posts are working and getting attention?
Well, first of all, LinkedIn, it should have a face, ideally. So take a picture, make sure you're not just putting out text. It's got to be engaging. You've got to have a call to action. Even if it's as simple as, well, tell us what you think about where interest rates are headed in the comments below. Ask people to weigh in because they might not if you don't. If you're doing a post about something like asset management, what's the most interesting thing you've done to drive revenue at an apartment? What's the most creative new source of income? So make sure you are being engaging. You're right about putting the links in there. That makes it very difficult. Your post will get throttled. LinkedIn does not want to see you leave LinkedIn. I don't know what they're thinking. Maybe just think that people who are in business just spend all day on LinkedIn. I kind of disagree with that strategy, but it's not my company. So you want to put that in the comments. And so I'll say, hey, I've got a great podcast today with Joe LaFleur. And guess what? Link in the comments below. So that way it doesn't throttle the post because they're not going to throttle your post if you've had links in the comments because everybody puts links in the comments. So then maybe moving on to podcasting, I found that it really helps to be out on all channels. So that's why I'm on Instagram. I'm on TikTok. You go to literally any social media, even Pinterest, and you will find my posts there. Because if you're going to go to all the trouble, and I know you know this, Jonathan, I think you've got over 40 episodes, you've got to really work. It's not just about putting out a quality product. That's step one or step zero. Step one is really getting out there and making sure that every social media channel sees what you're doing. And then when it comes to YouTube, I use Fiverr. You can use Upwork, whatever you want to use. Go find yourself a good video editor. It might only cost you $5. And guess what? You are going to get a video that's going to be 10,000 times more engaging. So I would say you definitely want to engage freelancers. Nobody can do this all on their own. If you're out there looking for deals, you're creating content, and you're editing your own videos, you're working way too hard.
Great advice. Yeah, there are a lot of good nuggets in there for any content creators or aspiring content creators. It can be really intimidating, and so the use of VAs and creating engaging video, there really is a strategy behind creating an engaging video in terms of thumbnails and titles and text to work with YouTube. And you're really partnering with YouTube, because any YouTube viewer knows that what you see on your feed is not necessarily what you're subscribed to, but stuff that YouTube believes that you will enjoy and will keep you on the YouTube website. And so creating engaging content, particularly on YouTube, is more important now than ever.
Yeah, I would say advertise too. I mean, I've gotten really great results just through organic promotion of my own podcast. But man, for $10, I saw my downloads literally explode. It's not about bots. It's about getting it out there on social media through some different channels, bringing you some new people. And you'll know whether it worked if after the campaign is over that your click rate continues to improve over the baseline.
What advice do you have for people listening to this that say, I know networking is important. I know I should put myself out there on LinkedIn and do some posts. And I know I should maybe do some YouTube videos, but I'm nervous. I don't have the right tools. No one's going to listen to me. I'm scared to go out there. What advice do you have for people that are reluctant to put themselves out there?
So I would give you two sets of advice. The first is that not everybody has to do that. I would say networking is good for everybody. I think everybody should go to at least a local meetup a month. But if that's really not who you are, partner with somebody who is more social. If you need to raise capital or whatever other aspect of the business you need a great networker. But if you do decide to go out and do it, you got to be all in. And you got to be very, very consistent. Pick your channel. For me, it was podcasting. YouTube is second, and you have to stick with it. Make your content consistently. Get a VA, somebody who can keep you consistent, because you're not going to be able to get out an episode every week or two or three, whatever your release plan is, without having some help. So make sure you professionalize it. Get your VA, get your professional graphics, voiceover, whatever it takes. Do that early on. Don't make 50 episodes and then say, okay, this is fun. Now we're going to professionalize it. So if you do jump into it, make sure it's with both feet. Be consistent. Give it at least a year.
George, this has been a great conversation. We've touched on a lot of different things, from housing data and macroeconomics to social media, building a personal brand. Is there anything that we haven't touched on today about these topics that you want to add to our conversation?
No, I just want to say, great job, Jonathan. I think you really did an amazing job of covering what I have to offer. And I want to thank you for an amazing interview.
Thank you for your kind words. If people are listening to this and they want to connect with you, you'd mentioned a podcast, YouTube channel, Horizon Multifamily. Where would you like to send people?
Yes, you can come out to horizonmultifamily.com if you'd like to invest with me. You can fill out the questionnaire. If you'd just like to learn more, we have a short form that you can fill out. You can reach me through LinkedIn. I'm there all the time. Send me a message, send me a connection request, follow. And I like to be very responsive. So again, if you've got a deal, reach out to me. Whatever channel you need to, you can also send it through Horizon. Just give me your contact info and I'll get right back with you.
Great. You've been really generous with your time today, George. I sincerely appreciate you sharing some time with us, sharing your knowledge and expertise, and look forward to connecting with you again soon.
Absolutely, Jonathan. Thank you so much.
All right. Take care.